Can you explain what you're talking about when you mentioned low liquidity?
Well, you can't get out is kind of one way to say it. Small to mid-cap stocks, if you get a guy who runs anything more than $250 million and has a position that is, call it 5% or more in his book on that kind of a capital base, and it's a small cap stock, you can't get out. It's going to take you weeks to get out of some of these positions. So what a lot of people do is they actually have liquidity rules. It's a pretty good idea. If you can't get out in a certain amount of days of trading, then you can't have the position on. So again, liquidity rules really matter here. What's happening here is that the sell side, the old wall, no longer puts capital up for risk. So again, you can't call like Whedon or you can't call JP Morgan and say, hey, put me up on 250,000 shares of Yamana Gold. I mean, that's just not going to happen. When I started in the business, that was the business. Actually, that's how I learned how to trade. And you can definitely scare some birds out of the trees when you're trading size. And we would force the sell side to take risk capital, or they wouldn't do business with us. Now they're all just like gone, crickets. There's nothing. So there's the machines, and there is a huge void of liquidity when people need to get out of an exposure. And that, again, is specifically in the biggest bubble, one of the biggest bubbles we've been identifying for over a year now, which is the Russell 2000, because you have so many illiquid stocks and so many people that are benched to an index that won't go down as fast as the stocks.
Indeed. And just a nice Tiffany bow on that. So I just pulled up a chart here on Russell 3000 turnover. Russell 3000 is the broadest measure of the U.S. stock market. That's down on a trending basis. Turnover. So it's the
daily turnover?
Volume times price is down 60% from the 2000 peak.
Wow.
60% on a trending basis. Like it just structurally bearish.
I bet you the average size of a hedge fund is up 60% or more from there. Because when I started it was when it was called Dawson Sandberg. We were one of 10 hedge funds that ran more than $1 billion. So it's got to be way more than that. There's got to be way more guys running way more money into way less. I mean, it's like, I use this metaphor if you haven't tried it at home. It's like mashed potatoes through a garden hose. Try to jam them through. I mean, it just doesn't work. So again, this is a very scary situation from that perspective. And the Federal Reserve is going to have to ultimately reconcile that or be responsible and accountable to that, because they've really encouraged people to chase asset price inflation on falling liquidity. I mean, there's no way Ben Bernanke can have the courage to acknowledge that, but that is the fact.
Indeed it is.